Okay, good afternoon, guys. Welcome to another live trading clinic. My name's Steve Ruffley. So, Bank of England today. It's quite interesting. A lot of the media now is talking about even an interest rate rise at the end of the year, early 2015. As you know, if you listen to any of my sessions, I've been saying this for the last 8 or 9 months on FX Street. Reason why why cable, the pound against the dollar, it's at 6 years high, because a number of reasons why we have to move the interest rates in the UK. Housing bubble, the housing situation has to be addressed. The fact that people are using houses not just as a place to live, but as a form of investment, the dynamics has changed. The prices are just not sustainable. And I don't care what anyone says. People, that live in London have a rose-tinted view of this because they don't know any different. And a lot of people in the UK don't know any different. It's not their fault, I'm afraid. But the fact is, once you start, using houses investment vehicles, then they start to behave like investment vehicles. So anything that goes up in value will go down in value. And I think there'll be a point in the future where the thing that makes house prices correct, crash, whatever you want to put it, whatever term it is, just a natural thing that's going to happen, is that there'll be a period in time where there's a complete excess supply. So there'll be a certain point in time where Generation X, the people that own all the houses, I pass them on to the kids. The kids have absolutely no interest in the houses, just want the money, and they'll just flood the market. Or scenario B, the more sanctions put on Russia, the more billionaires take their money out of the UK and London. That causes a crash. Or basically just becomes unsustainable. People just don't want to come to London anymore because you don't get the cheap labour, you don't get the people looking for, the streets are paid for gold scenario. People just go somewhere else. So the people, that flood London will just go. All these kind of things will have a ripple through effect. You've seen in the north of England, you've seen in Scotland, places have negative equity. All these kind of things have a balance. They're all going to come round. So interest rates is a huge and very, very important part of this. We've lived in an interesting time in the last 20 years. We've seen massive growth, we've seen massive prosperity, then we've seen the markets really contract and see a credit crunch. And I don't really think we've fixed the credit crunch. Stock markets are high, not because economic conditions are good, because no one's got anywhere else apart from property to put the money. So interest rates are going to make things a little bit more of a level playing field to be able to put your money in a bank once again, because you're going to get interest. Things that you invest in will get naturally, will appreciate in value in the normal way. The whole point is, we've got bonds at record yields, we've got the indices at record highs, we've got houses, back to pre-2007 levels. You can't make money in everything. That's not how you're taught to invest. When I was at PricewaterhouseCoopers as a young trainee investment advisor, it's all about having a balanced portfolio. You speak to anybody who's got any kind of money, and I say proper money, anything over a couple of million quid. It's all about a balanced portfolio, keeping it in check. And when you start to make all your money in bonds, all your money in indices, property, then something's got to give. And unfortunately, it's not the everyday investor that's going to pay the price. The everyday investor's going to pay the price. It's not the big institutions. It's not the people with lots of money because they can spread the risk. So something will give, and interest rates starting to go up mean naturally that the indices should start to sell off. I wouldn't say the indices are selling off just in anticipation of rate rises. They're probably selling off for the pure fact that they're just completely overpriced. But when you look at 2014 being the biggest merger and acquisition period in pretty much history in the US and the UK, what you're seeing is capital going to where it thinks it's safest. So just because the markets might take a big correction doesn't mean that the stock markets are not a good investment. You still get your bonds, you still get your dividends. And I think people are realizing that property, although it's a great investment and people have to live somewhere, if you look at countries like Germany, New York and different kind of places, we don't all strive just to own our own property. And people are owning property at vastly inflated prices, and they're just not worth it. They're just not worth the money they paid for. So something's going to give, something's going to correct. And I've been saying this for a long time. The interest rate in the UK will be first to move, not just because of the housing bubble, but, the fact that things are so expensive, the inflation. People, are using food banks. We're a rich country, a very, very rich country. And the proportion of wealth is just vastly divided. The gap between the rich and the poor is the widest it's been in history. And again, I'm a big believer in history. The technical analysis I use, looks at historical things to predict the future. But fundamentals are historic and predict the future. The world is historic and will predict the future. When the gap has been the biggest between the rich and the poor in previous years, things have corrected, things have happened, bad things have happened. So we're at that point in history now. And just to think that quantitative easing has stopped in the US, we're going to stop the asset buyback purchase in the UK. Are we really naive enough to think that just pumping and printing money was the was the real solution to why we got in this problem in the first place? No, probably not. Anyway, what do I know? So, risk warning. Expect better to see the trading carry higher risk or capital, resulting losses than exceed initial deposit. It may be suitable for everyone to please understand fully understand the risk involved. The information going to provided in the hearing, but all circumstances considered an officer to invest, not to issue investment advice. The information provided is accurate the data produced. Education only. Content webinars, person of moderation, and intraday content not constitute financial advice or tax advice. Intraday content and the content from the section. So we're going to go through some live charting analysis, multiple time frame analysis, and trading. Fundamental analysis will be what we're looking at, the data today. So expected unchanged, 0.5 for interest rate. Doesn't mean we're not going to see a movement. I like it when the market expects nothing. When, we saw that the other day. I mean, it depends who you watch or, who you look for non-farm payrolls especially. But I like it when a non-farm payroll is expected as nothing, in line. Nothing's going to happen because you always get that market. That market sentiment priced in, and then if something does happen, you see the big movement. So I don't like it when it's massively out of line, as we saw 2 months ago. 211 came at 288. I like it, more like last non-farm payroll. It's pretty much in line, so people don't really know what to do because then you can take that advantage and take that, understanding you've got of the markets and make it your own. So today, just to say interest rates aren't going to move, I think that's fairly certain and priced in, but it doesn't mean that there's not going to be some movement in the markets. Already, I was saying the first quarter of 2015 when we're going to move on interest rates, but already some analysts are saying it's going to be earlier than that. I don't see it personally. I see it before, in 2015, probably the first quarter. But it just goes to show how economic data and cycles, do really happen. So we're looking, we've been in the growth phase for 7 years. Okay, 7 years of just talking about GDPs, non-farm payrolls, employment, consumer, spending, all these kind of things, what we're focusing on. So we're focusing on them kind of figures. But now we're going to be looking at inflationary. Once you talk about interest rates and, have an interest rate rise, then really we're focused on the inflation type figures. So CPI, PPI, all these kind of things are going to come back into the fray. So everyone's put up with, higher prices. If you go into the supermarket, everything's more expensive. You go into the petrol pump, everything's more expensive. So people put up with it. Again, people put up with it because the majority of people in the UK do own the whole house. So, they've seen a rise in the house, so it keeps them pretty quiet. But if anything happens to that, then people don't have much savings these days. I'm talking about ordinary people. They don't have much savings, they still have debt. So when we start to see interest rates rise, even if it's only by, a quarter, half, a full percent, it sounds nothing. It sounds nothing. That's going to make a big difference to people that are servicing big amounts of debt, okay? It'll make a massive difference. And all these people that have bought houses in the last 5 years with the mortgages that they've lied about what they earned, lied about what they're going to get for this year's bonus, their real wages aren't going to go up. And once your house stops appreciating, you stop making that money in your house, then it's game over. So, I don't know. It's something I've been saying for a long time. And it's something that, really does surprise me that nothing's been done to address it. We've not stopped people buying houses. We've not stopped, made money, less readily available. We haven't stopped payday loans. All we've done is encourage people to stimulate the economy, which they've done. Thanks people out there. They've stimulated the economy by consumer debt and personal spending. We haven't stimulated the economy by what we meant to. We recapitalised the banks so they'd lend to small businesses and create jobs. We haven't done that. The banks won't lend to small business because too much of a risk. So banks just lend to big businesses so they can get even bigger. It's a crazy, cynical world we live in, people. Cynical world. So that's why the stock markets are high, because they're the only one that's got any money. You've got people like Amazon, you've got people like Microsoft, Apple, that have got more money than countries. Is that the way forward? No, I don't think so. Anyway, let's see what's happening in the market. So over Bank of England, no, we're not going to look at the euro dollar because, we'll go through euro dollar quickly. I've been massively bearish the euro dollar for quite some time. And again, that's something you've listened to at FX Street I've been saying for a long time. So it's no surprise that we're starting to sell off. We've got some big levels here. So once we break, these kind of regions here, the kind of 132 level, we've just got this big gap down to 127. Okay, so this is your technical kind of stuff. You look in your monthlies, they're really looking for real value. Keep saying, look at these lower highs being made. Yeah, just simple. I mean, simple technical analysis. You don't have to be a genius to understand that when the market starts to move down through these peaks and through these highs, then we get down. So if you want to see where the euro can potentially get to, we'll start with the so-called rally started up here. So look for that 50%. Where's that 50%? Ties in these bottoms here. Not coincidence, guys. So we're going to hit the bottoms and really get, much lower. We've got over 10,000 ticks to go of value in the in the euro. So again, just go through the weekly charts. You can start to build up a picture. Not as clear cut with the lower highs, but really you can see it kind of peaking out. Again, these kind of formations here. We've bottomed out. Market's had good support, but we've topped out here. Look at these wicks on the top side, telling you, that the buyers are running out, and these are the high time frames. So the daily is very, very, very clear. We've got this. I wouldn't even call it a trend channel, but you've got this downward movement. It's very structured. We don't like to peak and close above these lines. Again, you don't have to make them too perfect or too pretty. That's a little bit too steep really to use, for a technical analysis point of view. But it's just getting the idea that the market is topping out and looking to move down. So the euro is going to get completely smashed. Mario Draghi's not going to clue what he's doing. The rest of the civilized world, we'll have to class Europe as a civilized world, are looking to move on interest rates to control, just to control the situation, to control borrowing, to control life. And, Mario Draghi's got negative deposit rates to the bank, talking about cutting interest rates and bringing in quantitative easing. I mean, what's going on? Why didn't he do this when the rest of, the Europe and the US were doing this? Why is he doing it now? And to me, all he's trying to do is shore up the world central banks, and he's trying to shore up his position. He's not trying to help the people in Europe. Greece have got more debt than when the credit crunch happened. Spain still completely destitute, highest unemployment, of youth that it's ever had, and probably one of the highest in Europe. Italy, again, you can't trust Italy, just to manage their fiscal policy correctly. Again, they're coming under fire. And Portugal, again, it's, the pigs have just proved to be completely inept. They took all the money 10 years ago from Europe, got all the infrastructure, spent that, and have got nothing to show for it. So they're like a bad child. They're just like nothing. You're not getting anything back from any of these countries. And, just because the world markets will lend to Greece doesn't mean that's right. It doesn't mean it's right. It doesn't mean they're going to pay it back. So I can see quite easily within the next 5-10 years that the euro is split into north and south. Potentially, it's going to be something, as predictable as Greece just saying, you know what, I'm not paying the debt back. I'm not interested. I'm out. I'm going back to the drachma. I think that's the most likely scenario for me. And anyone that thinks differently, again, let me know your comments, guys. But for me, realistically, we'll get to a point in debt, get to a point where people are just sick and tired of, being controlled by Europe. And Europe doesn't really, you think about in England, all the kind of European legislation, it doesn't really do us a lot of good. And, we're a clever nation. We're a nation that started, we used to rule the world, we used to have empires. We've got a good judicial system. I think we're fairly fair when it comes down to how we operate. And why do we need to be told what to be done by Brussels? What have Europe really brought to the table? For me, not a great deal. So I would say Europe can pretty much do one, in my opinion. And when they inevitably, just get tired of squabbling between themselves and go their separate ways, and, Europe does break up, I think we'll understand that the experiment, and that's all it was, of having that great big, a great big, kind of unified, a great place that's going to rival the US economy. Once we understand that, it can't work because of people. People make these things work and not work. At least in the US, you've got a huge, diverse number of states, but they're all one race. They're all one American race, one set of people. In Europe, if you go to Italy, go to Sicily and say you're Italian. So no, I'm Sicilian. So how are they not Italian? How they're not European? The European thing just doesn't really exist properly, and it never has done, and that's why Europe won't work. So we've seen a bit of strength coming back into the pound today. So I guess that would come through, the interest rates are back on the agenda. And maybe there's a slight, a tiny chance that we're going to see a rate hike. But, I wouldn't see it today. So we're seeing a little bit of strength come back into the market, but only really back to the 50% on the hourlies. So one spot 68577 would just be a natural point to pivot on from here. If you go into the daily charts, we've been selling off. And this is all the kind of institutional people and all the big traders that are selling off, because we all knew that interest rates were going to come to a head at some point. So while everyone else is buying into this rally, all the retail people go, oh, yes, well, yeah, Bank of England going to raise rates, so it's probably a good time to buy the pound. Yeah, we'll just take the pound down as low as we can. Get all the retail traders out, and then we'll bring it back up. So that's how markets work. Markets know what's happening before you do, and it's not a conspiracy. Don't start crying. Don't think there's some big, controlled conspiracy out there. That's what I love speaking to people that can't trade. People that can't trade think there's some conspiracy. They think there's somebody out there that knows more than they do. Well, there is. Yeah, there is people that know more than they do. But the whole point is why people buy into these conspiracy theories because they don't understand why markets work. If you understand technical analysis and the self-fulfilling nature, then if you understood all the rules and you had unlimited money and unlimited time, would you play by the rules? When I was a trader, professional trader in the city, I had fairly big size. So if I wanted to break a level, I'd break it because I know I'll be getting the lesser traders out because I know that everyone would want to go short that level. So I'd break it, for 4, 5, 6 ticks above, get people out of short-term positions, then bring it down quickly. This is nothing new. If you get a non-farm payroll at 211, and it comes out at 288, what are you going to do? You're going to buy the S&P because 211 is good. 288 is very good. So you buy the S&P because it goes up on a better than expected non-farm payroll. What does the market then do? Well, as we saw, it sold off 40 ticks, not 5 ticks, not 10 ticks, not 15 ticks, because people are running a 1% stop. 1% of your capital on a trade is the average stop for a person. I know because I teach that people. Well, I don't teach people that, actually. I teach them to be much more flexible because of this reason. So if we all know in the market, as big banks, big institutions, big private traders, that people are going to buy, what do? Well, you take it past that 15, 20 ticks of 1% risk. You take it 40, 45, 50 ticks. And then what happens? Everybody who's retail gets out. What happens in the next 5 minutes? The market scrambles, buys the bottoms, and goes on to make a new high because all the small, unexperienced retail traders are out. So if you know all the rules of fundamental trading, all the rules of technical trading, then that's why markets behave the way they do. It's not manipulation. It's just people knowing the rules of the game. And if you don't know the rules of the game, you lose. Right? And the whole point where I wrote my book, it's going to be published probably in January at some point because obviously lazy publishers are too busy to edit a book over summer. That's what I've been told. So I've wrote this book, 250 hours, 35,000 words. Oh, no, we can't possibly do it on summer because, everyone's taking little Johnny to Spain. So again, that's just, the world we live in. It's boring at sometimes, relying on people to do other things. So when I teach people to trade and when people have private sessions with me, they get the truth. And a lot of people, I'm not going to go all Tom Cruise here, but they can't handle the truth. They don't like to not understand that if they don't learn more about technical analysis, then they won't get better. You won't get better. Okay? There's only so much technical analysis you can use. And it took me a long time to develop my software and systems to break it down to be as simple as you see on the screens now. Okay? This is as simple as I can make trading. Sell at the red lines, buy at the green lines. Okay? I cannot make it any clearer. And then when you break through these bottom levels, these really low fibs, just keep selling until the fib lines redraw. Because once you broke through the hourly value and you're below the low point, there is no support. Okay, so all you're going to find, there's no resistance. So you're going to find support down in the lower levels. Okay, so simple. It's people. People think there's a big mystery to trading, but there's not. I mean, if you look on the dailies, on the FTSE, again, we can see we reach these peaks, and gradually the market's telling us it doesn't want to go up any higher. It's the faintest of trend lines. But it's showing you, it's down. It does not want to go up any further. We've reached the highs. When we get to this point, the market starts to tell us again, look, 1, 2, 3, 4, 5, 6. 6 attempts that it's told us that it doesn't want to get any higher than 6819 spot 30 in the FTSE. And then we break down. Where's it going to go to? 80% of the time, strong directional move retraces 50%. Okay, that's the rules of Fibonacci. That's my rule of Fibonacci. So what do we get to? 50%. Okay, so the market tells us doesn't want to go any further. Gets to 50%. 1, 2, 3 days of rejecting that. So you don't have to sell it here. Yeah, wait for extra confirmation. Wait for that 50%. 1, 2, 3. Yeah, could have sold it. Put your stop in of 20 to 200 ticks or so, I guess, and you'd have made 1,000 ticks. So 1 to 5 risk reward ratio. Yeah. Anyway, the FTSE was always going to correct. I think we all knew that. Is this the end of the correction? Not sure, to be honest. I still think we've got a bounce in us. And again, we've kind of priced the interest rates to a certain extent. Once the market starts to talk openly about it and gives us forward guidance, then people are going to say it's a sensible thing. So maybe we'll see a relief rally, and the market could potentially still go back to 7,000. The DAX hit 10,000, the S&P just missed 2,000. Down made new highs. So there's no real reason why the FTSE couldn't get back to 7,000. It looks like we've come down a long way, but we haven't. If you go on the monthly charts, look at all this buying here. We haven't really retraced any kind of real amount. So for sure, the FTSE could get back to 7,000 at some point. So don't be fooled into thinking this is the end of the buying. The trend is still heavily up. Gold's an interesting one. I think we continually keep pivoting around the 1,300 mark. Again, I think once gold breaks 1,280, we're going to see gold absolutely plummet. I mean, gold again, the same pattern as the FTSE until we got to this period here, very very strong. But I think the world knows there's not enough kind of fear and greed to send gold back to back to the highs. And that 50% is clear. Look, we're trading at 50% again, so we're consolidating. So we have every chance of gold going back up if we think the Russia situation, general fear of the market, is going to push it back up. It's never going to get back to 1,800, that's for sure, or 1,900. No, not a chance. But I would say really is we're going to consolidate probably, and then once we break these lower levels here, gold's going to get down to what I said, about $1,000 by 2015. Think about this then. If you're into conspiracy theories and think about control and all that kind of stuff, Gordon Brown sold all the gold pretty much in England at the lows of gold. There's rumours that there's no gold in Fort Knox in America. That's how they funded a lot of the the kind of things they do, by selling gold. Think about countries that do have gold. Okay, China, India, Iraq has a lot of gold. Iran has a lot of gold. So they're pretty much bad countries in our eyes. They're not as kind of civilized as us, and they're a threat. So if you think about control, you think about all that kind of stuff. If you want to take a country's wealth away, and you want to take the power away from physical stores of wealth, then you make gold less valuable. So if you don't want China or India or Iran to have these big stores of gold and it's worth nothing, then what do? You make the price of gold nothing. You flood the market. So maybe, you can into conspiracy theories that's the reason why gold's actually coming down. It's because we don't want other countries to have a store of wealth. We want to control it by currency. So think about that. England has no gold, we know. Fort Knox was a rumour, like I said, that it's actually no gold in it. It's actually empty. So, again, there's a reason why gold, hedge funds in gold have all gone away, because really there was never a shortage of gold. It was just, again, an old-fashioned way of thinking. And once the kind of speculators have gone out of gold and pushed it down, then the market continues. You don't see cash for gold adverts anymore. You don't see, people cashing in gold because it isn't worth it. It was worth it up here. Yeah, it's not worth it down here, and it certainly won't be worth it down here. So the trend for me for gold is going to be down. And once we break 1,280, as I said, I think we'll probably see that drop in gold be huge. Be absolutely monumental. It'll just kind of completely sell off for days and days and days and hit these lower levels. And once we hit $1,000, probably have a bounce, to be honest. But yeah, okay, it's going down. So if you listened to me over the last, I don't know how long I've been trading on FX Street and talking, 4 years, you'd have probably made about 10 million quid if you had just done exactly what I said, even with a small account. But it's one of these things, guys. Again, them that can do, them that can't teach. So I like to think I do a bit of both. I trade, I do a lot of things on the side, and I make money. I do this stuff on FX Street because I have a profile, and being the chief market strategist, I have to be in the media. I have to be in the presence. I enjoy it. I enjoy, interacting with you guys and saying my opinions. Who wouldn't do that? So I trade. I make my money from trading. But on the side, I do all this other, I guess it's kind of fun stuff. It's kind of nice to write books and, go and speak to people and be a bit of a mini personality within this kind of realm. But, again, everything I tell you, everything I talk to you about is because I'm doing it. I'm not just sat here saying that, I wonder if interest rates will go up. Like a lot of the people that you hear speaking and presenting, I've been, backing these things up for a long time. So we've got 5 minutes before the Bank of England come out, and I'm pretty sure it's going to be unchanged. But if we do see a hike, then we're going to see an interest. We're going to see the markets, UK 100 FTSE smash back down. That would completely just disintegrate. So a lot of lower levels where the market could get to. Gold, I would say, would probably take a bid, get to these upper fib levels, and that the pound would break these levels and get above 1.7. So big level at 1.69127, and then again more to 1.7. We've got previous levels, so they're not brand new highs until we get above 1.71888. That's when we see the market get back to the existing short-term highs. Yes, Ian, good to see you. Yes, we're pretty much on the 50% you're right on the monthly chart, and it's working pretty well as support at the moment. It is, but it's a target for me. So again, the trend for me is up. So that's a target where the market's going to hold. So again, when the markets are more aggressive, they're nice as a support level. It's nice that it's a target. When it breaks, you'll see the market, if it's a technical break, which I anticipate it will be, you see the market break up, come back down to that support level, resistance level, and then the market will find support on that level and then move on. So that's the kind of scenario you see. You can always tell a fundamental and technical break the difference, because what was support becomes resistance. When it's a fundamental type move, it will be, it'll gap, or it won't retrace back to the key 50% and then go up. So what you'll see is the market, what was resistance will react to support, and then the market will go in the opposite direction. So I think once the market does tip its hat, again, everything's priced in. So the market's already anticipating the interest rates are higher this time next year, but it's just waiting for that confirmation that if we see interest rates go up today, then that's it means that this time next year interest rates will probably be even higher than the market anticipated. So that brings more people to buy the pound. Bigger interest rates, more people that buy pound because it's worth more money. So that's just as simple as it works. So we're expecting unchanged today. Again, the Bank of England has been a bit of a damp squib, I guess, lately. But I've stuck with it. I've persevered with it because of my view. And when we come out and interest rates do move, we're going to see the markets move. But it's interesting because even though the markets don't necessarily move as much as non-farm payroll, it's still just as important. I mean, you get one non-farm payroll every month. You don't get interest rate decisions, as often. So the bigger in magnitude. So when something does change, and the equation does switch round, then it's much more powerful. I would say that interest rates, again, 7 years we've been on historic low interest rates, and it's crazy. It's really crazy to think that we thought we were going to boost the economy and keep it ticking over and thriving on low interest rates. It just to me seems like such an alien concept. You recapitalize the banks, you own the banks, you tell the banks what to do. And yet again, we're too frightened. We're too frightened to tell the banks what to do. All we do is fine them and, get our money in a sneaky way. Why don't the banks, want to help the country? If something happens to London, the prosperity of London, the banks are all finished. Why do we not look at the bigger picture in England anymore? It's very worrying, to be honest, and it's very boring. Okay, so just a minute or so before this data. Okay, do I think the pound will rub off a bearish tone today? Well, we've pretty much, again, retraced all the losses that we've seen in the last few hours. I would say that the trend for me, although we've been selling off for days, the trend's still up. So realistically, what you're looking for is these lower levels hit down here to act as support and then make new highs. We're still pretty much in an upward trend. So we're just naturally kind of, we broke through this trend, so we could potentially see the market, break these lows here. But what I suspect is, we get back and this line would act to support resistance. We gradually tip back up and go up because we know what's going to happen. We know rates are going to rise at some point. That means the pound against the dollar until, the US raises interest rates, is going to be more attractive, more valuable. Remember, the Fed quantitative, easing to infinity and all that kind of stuff. They're still got a way to catch up. We're a lot smaller. We're a lot more nimble. 10 seconds, guys, till this data. Expected unchanged. Pound's taking a bid. Unchanged. Okay, rates unchanged as expected. So you just see a little bit of profit taking now. A little bit of profit taking now that news has been released to the market. So any speculators just getting out. Watch for the fib lines to kind of work here. 1.68457. You want to see the market get back to. I guess that's pretty much 50% of that move, of that hourly move here. No, it's 61.8%. So the 50% we're trading now. So again, this might have been some speculation that they're at a rate hike. So any short-term speculators who are people getting long for that decision, getting out now, and that's why we're seeing the market retrace. Okay, so unchanged. Nothing really kind of coming out on the wires, nothing else being said about that. What we'll be looking for in the next kind of days, weeks is some clarification and confirmation about when, Mark Carney, the Bank of England, are probably going to do something with that. So no move in the FTSE whatsoever. Gold didn't pay any attention, but we saw how the market reacted on that 50%. When the new hourly candle opened, we did trade back. So look on the smaller time frames. So the 5 minutes, again, we saw that little bit of speculation creep in, market then came down. So the 50% is here. So this is going to be a pivot point now. So the market anticipates that potentially with unchanged and nothing being said, maybe the market is going to then dip down to these lower levels where the kind of market bottomed out. But realistically, what I think is we hold above the 50% and then we go up from here because the market's unchanged. So we haven't seen a rate hike yet, but there's still the talk and the chatter in the market is that interest rates are certainly going to go up. And as long as the rumours kind of support that it's going to go up in 2015 or potentially before, which I don't think it will do, the pound's going to remain to stay strong. So 5 minutes, we could even do a Fibonacci on that 5 minutes. Get rid of all that. So we've got 3 minutes or so. So we've probably got a range in this candle for the next 5 minutes. So if you go on a pure Fibonacci principles, or my principles anyway, that if we hold above the 50% and the trend was up, market will make a new high. However, if we retrace that move and hold below 50%, market will make a new low. So the new low is here, down here. Okay. But when we're saying low, we're going off the Fibonacci. So new high, it will be off this candle. But significant high or low would be on the I guess the higher time frame or even the 5 minute levels, which would be up here at 168.585 or down here at 1.68364. So just 2 minutes. 2 minutes we'll see now how the next candle opens and watch that 50% pivot, see if we make a new high or low. Did anybody trade, guys? Did anybody do anything on the back of that? Again, it's very difficult, isn't it? We've got an unchanged figure to actually press the button and do anything. But like I said, you'll always see a move in one of the markets around these particular announcements and data because there's people trade markets. So somebody out there will be taking, a punt, taking some speculation. That's just how markets work. So towards the low of that fib, so if we do break below that low, we might have to redraw it. But again, you generally see in the first couple of minutes, the initial direction and momentum kind of take course. So just towards them lows now. So got every opportunity for that to move that a little bit lower. So I might have to redraw the fib in a minute just to see and take into account what we class as what we know, what happened in the past. Again, you can't really go any lower than 5 minutes, to be honest. You don't want to trade tick data or minute data. It's just, if you're a spread better, then, you're always paying the spread. You can't get the price you want. So you shouldn't really zoom into that much. And I only use 5 minutes on the back of data. Really, the smallest time frame I'll use is the 15-minute and hourlies. Even with intraday trading, you get a bigger picture. So towards them lows now. So got a minute of trading. We might just see it, blip that little bit lower. We're on the lows now. So I'm going to leave the 5 minute in anyway. I've got that 5 minute fib in anyway. Even if we go back down, that 50% is going to be somewhat there and thereabouts. You don't have to be too precious about, technical analysis. People, love to have absolutes and I can't think of outside the realm of technical analysis. Well, there we go. So we just traded towards the low. and they actually open below the low of that fib. So that is a negative thing. So you probably see a quick bounce back up, just because markets generally, do that. They generally just open up to the low and then come back, for a little tiny bit of short-term profit taking and then blip back up and then continue in the original direction. So let's see how that 50% works, because we're only really, a couple of ticks on that low. So, 9 ticks. So no harm, no foul there. So look how, if we don't get to that 0%, we don't get back to that level and test it, then the market, is going to, rapidly drop off. But as I said, as I'm generally always right, the market's going to look back and take a little bit of profit into this candle and this selling. So look for the 23, 38, and 50%. Okay, that's what we're looking for now. And then the markets from this point is either going to then, break back down and continue the selling momentum, or we're going to range and then make a new high. So look how the 50% of key fibs act. The more we don't get above the 23, 38, or even the 50, the weaker it looks. Okay, so don't get above here, sell. Don't get above here, sell. Don't get above here, sell. Yeah, and the stronger we get down, and the stronger we can't test the 50%, the stronger these levels become as a sell. And your break point is back at the 0.0, and your target is these lows here. So your risk reward from this point here is 41 to 100. Okay, so 2 to 1 in essence. Put your stop at the 50% if you want to go short, or you want to go long to that. Well, you won't put your stop down here, but you want to go long to the 50%. You stop below this low here. Any other questions? Any other thoughts, guys? This again all revolves around my 80-20 rule of technical and fundamental trading. Okay, fundamental accounts for 20% of trading activity, and then the rest of it is all technical, 80%. But your fundamentals will make the markets move, and fundamentals will trade technically. So again, it's keeping that framework, keeping these things in a balance. Very important that we understand that. And a lot of people think that they can't understand the fundamentals, and they can fade them and discount them. Why would you? It gives you a structure to your trading day, week, and month, and it's just good. It's good to trade the data and understand it, because you get an idea of what people and traders are thinking. And it's not a guarantee the market's going to move, but the markets, will generally focus around these events, and there will be some action. So it's just a good thing to be involved in. So we're going to see the markets really, I guess, we've not hit that 23 to the pip. So the more we don't hit it to the pip, the more bearish it is. Okay. So we're just getting back to this point here. And remember, just best thing to do, guys, take your screen print. Okay. Let me put some lines on first. So this is the scenario right here. Okay. The 50% is the pivot. 1.68515 is the pivot. So the more we hold below these Fibonacci lines, the more bearish it is based on this 5-minute candle. And if we make a new low, that's where we're going to break here. And if we break that, then we're going to get to this level down here. Okay, this level here, this one spot 68364. So this your trade kind of setup. Your pivot point is here. So the more we stay below that, the more we're going to make a new low. Your break point is here. Yeah, your target point is here. So you put your stop at the 50%. You're going to go long into this, and the market breaks up to 50%, and you think it's going to get some traction. And again, take on this momentum and go high. Then your break point is the top, obviously the high, and then your potential profit points are up here. Okay, probably putting that. So realistically, from the 50%, you've got just as much money to make. 119 ticks on the way up and 150 on the way down. So it's where you get involved, isn't it? Again, trading's not about being right. It's about being right at the right time. So what we're going to do is look for this 50% to tell us what the market wants to do. So the more we hold below the fib line, the more we'd want to go short, and eventually the market's break and get down to here. Or if we think the market's going to retrace all this move, then we get long when the market finds support on the 50%, break point, profit here. Okay, so take a screen print. Just press print screen or use your screen grabber or whatever, and look at them levels look at them every 15 minutes or every hour for the next couple of hours, and you'll see that one of these things is going to happen. So we're either going to make a new low and get down to here, or we're going to hold above the 50%, make a new high and get to here. Okay, that's inevitable. Okay, it's inevitability in trading. Okay, so it's just a time factor we have to factor in. But one of these two outcomes will happen in today's trading. We get as low as here, we get as high as here. That's an absolute certainty. Okay, Ian, a bit off topic. Yeah, I've actually written a few pieces about the Scottish independence thing. Um, I think how do I approach this? Do I go the usual roughly rant style, or do I just keep calm? And I think I'll just keep calm on this one. To be honest, I don't care. I don't care what happens to Scotland. I've never been. I'm not interested. I think what will happen with Scotland, it will be heads over heart. They're very passionate, Scottish people, but they're also a little bit deluded. If they think, all their money is going to come from oil, then, that's a ludicrous way of thinking. The Scottish were very unprepared for these kind of things. All they wanted to do is basically, like Russia, get on the world stage, make some noise and be heard. They're like little children. So what they haven't got is a plan. So the big plan is, we'll have our own independent currency that they'll be underwritten by the Bank of England. No, you won't. Already said you can't do that. Oh, fine, right. We'll go to the European Commission. We'll join the euro. No, you can't do that either. It's very unlikely you'll be able to join the euro because you have to spend years and all that kind of stuff, applying. Oh, right. Okay. Well, we'll just okay. Well, we'll deal with the currency, after the event. No. You got to deal with that now because that's people's lives. That's people trust in you. You have to have a good fiscal policy if you're going to be an independent country. So that's one thing. The second thing that we're going to put Scottish money back in, and it's for Scottish people, and everyone's going to have a fairer deal. Right. Sounds a little bit like a dodgy form of communism to me, that, or it just doesn't seem right. All these kind of big ideas, all these kind of big thoughts always seem great when you're talking about it. But in reality, when you have that initial excitement, you have that initial amount, you've got total control. As soon as you get total control, people can't handle it. And I don't think Scotland are A, ready for it, B, really want it, and C, have a self-sustaining economy. I just don't think they've got a strong enough economy to be outside of the UK. And there we go. We've just seen that market break through the 50%. So again, what we're looking for now is the market to find that 50% of support. And our target, as we know, is one spot. There we go. We've already hit it. So 1.68557. So that's that. So we're going to, from that point, again, I guess, make a new high at some point if we hold above the 50%. So quite a big reversal there. So if you did go, that's why I always like to leave both interpretations on the table. That it's not for me to save the market from this point. It's going to go up or down. I'm just telling you the scenarios, and you see how we've traded within that bar, within this candle here, how we traded within it. And the 50% we got to it, and then when literally within 2 seconds of trading, we've gone up 51 ticks. So again, it shows you guys these are the parameters, these are the boundaries, and what you have to understand. So, a few more comments coming through. Yeah, well, Salmon's going to say anything, isn't he? To be honest, without the oil, the GB, the pound's going to tank. Who on world stages listens to Alex Salmon? Who? Nobody. So, what will happen is gold, oil will probably take a little bit of a tiny bid, I would say, because the risks involved of leaving Scotland, in control of any amount of relative power. And then what will happen is that Scotland will go off, do their own thing for about 6-12 months, and then something inevitably will come up that they haven't thought about or they haven't accounted for. And, there'll be a lot of anonymity. There'll be a lot of, people in Parliament that'll take this, the wrong way. And, you've got to think Scotland, couldn't even build their own, this Holyrood, it was out of budget, it was 5 times more expensive than it was or whatever. They can't be trusted. Nobody can be trusted in the public sector to do these things. So you suddenly get, independence, you get a whole load of money. You're going to go off, you're going to go spending it. And then a couple of years' time, all the money's gone. And you think to yourself, well, we don't have the economies of scale anymore. We don't have, the amount of money coming through from a bigger country filtering through to make it all kind of relatively fair. We're on our own, so we're left to our own problems. So it's a bit of a non-event to me. And it's bit of an on-event, and it's we've got so much bigger things in the world to worry about. It's just Scotland once again going, oh no, yeah, the world's in turmoil, the world doesn't know what's really doing, so we're going to be independent. We'll just sort ourselves out. Oh, we're attached to England, but we've never really classed ourselves as England. Good, give them their independence, let them go on their own, let them deal with their own problems. That's what I say. And all this kind of stuff that is going to affect the UK. It's not going to affect the UK in the slightest. The UK is London. UK isn't Scotland, it's not Ireland, not Wales, it's London. That is the UK. So Scotland having its independence is not going to affect the UK at all. If anything, it's probably going to make us more attractive. One less thing to worry about. Okay, Manjo. Good question here. So we found that with most news announcements, if there's no surprise, then you just fade the initial spike, you tend to win more trades. Yeah, I mean, absolutely. I mean, we there was no real announcement. So again, what happened in the sell-off, was basically, retraced within the next 5 minutes, as you say. Absolutely. I mean, if there's no shock to the market, then, there's no reason for the market to move. It should then correct. So what we're doing now, see the market sell off, basically taking the profit of anyone that was speculating beforehand, got back to the 50%, made that high. So right now we're pivoting around this point here. So we haven't made a new high or low yet. Okay, so we still have to make a new high or low from this point. So the Fibonacci is still valid. So the 50%, if we hold below it now, we will make a new low and break here. But if we hold above the 50%, we will make a new high above here. So yes, good question there, Mandra. Yeah, you're exactly right. Yeah, fading the kind of initial announcement if there's nothing of significance is certainly very valid. All right, guys. Like I said, keep that screen up. Just do a screen print, and you'll see at some point we make a new high or low from that point, and you'll see the 50%, acting as support or resistance. All right, guys. Well, that's pretty much my time today here on FX Street. So I'd like to thank everyone for attending. And anything else you want to know, guys, get me on Twitter at Steve Ruffley. Plenty more stuff for me this month on FX Street, so look out for that. And it's been a pleasure. All right, guys. Have a great afternoon.